9, valuation of receivables, accounts receivable and notes receivable. We're jumping into the middle of the book. We have to get started quickly. To begin with, I want to review the color map that I use in accounting. Just after a long summer or a couple quarters since you've taken accounting, I want to talk a little bit about debits and credits again and the big picture, and then we'll jump into the specifics of this particular topic. Let's go take a peek here. I use a color map that, shown here, is an effort to show the accounting system itself in a big picture. It has a place for every one of the accounts, and it sort of helps you dynamically understand how they all work together. So you can see we have a balance sheet, that big blue box over here on the left. That's where we list all the assets of the firm that we're dealing with. And it's blue because I use blue to signify which accounts have normal debit or left-hand balances. And I use blue because debit has a B in it. So that's a good way to remember it. The red boxes are places where accounts exist that have normal right-hand balances, or called credit balances in accounting, and the word credit has the word red right in it, so that's why I use red to signify those. This blue-red helps you understand what the normal positive balances in those accounts are. And so we have 5 classes of accounts in financial accounting. We have assets, shown in this big blue box here. We have liabilities, shown here. Equity, shown here, is the third one, and then revenue and expenses. So that makes 5 altogether. Expenses and assets are made bigger on the left-hand side, or they're debited to be made bigger, and therefore you would credit them to make them smaller. The liability, equity, revenue, the 3 in the middle, are made bigger on the right-hand side. We increase the balances in those accounts with right-hand red credit entries. We always know that whenever we make a change in the accounting system from Accounting 201, we must have equality of debits and credits. That keeps this balance working. It keeps assets always equal to liabilities plus equity. So that big picture is what you need in accounting. You don't need to memorize every account in a chart of accounts that has 500 separate accounts. You don't need to memorize what a normal balance is in those. All you have to memorize is what is the classification of accounts that we're dealing with. So this classification issue is critical to getting anywhere. If you don't know what class, where it lives, you're in big trouble. You have to get to that piece first. Once you know that, then you know how to make those accounts bigger, and you know how to make them smaller. It takes some of the confusion out of debits and credits. The second problem with debit and credit mechanics is the fact that accountants love to use contra accounts. In this course, we're going to use lots and lots of contra accounts. Contra means it's opposite to the accounts that it lives with. It's contrary. It's different. It's backwards. The account that we learned initially was a contra was down here in the equity section from Accounting 201. We would have a capital account, a sole proprietor, J. Smith, comma, capital, and then we would have a drawing account, J. Smith, comma, drawing. Well, the drawing is contra. It's backwards. It's a hole in equity. When there's balances in that account, they're debit balances. Even though it lives in credit territory right here, the drawing was contrary or backwards. It made equity smaller. Why didn't we just go make capital smaller? Why put it into a separate account? It's because accountants love to keep track of how much has been drawn out during a fiscal period. So if we mingled that with the capital account itself, the original capital account, we lose that information. We have to go dig it back out. So you use contras to keep separate track of reductions in total to an account. Later on in this course, we're going to study adjunct accounts, where it's an add-on account associated with another account. But for now, let's just remind ourselves in the debit and credit process, quality of debits and credits. You have to classify accounts to get anywhere. If you don't know whether it's an asset account or an expense account, you better figure it out, because you can't do anything until you get that figured out. Accounting 201 was that drill, those exercises to help you figure that out. So when we add to that this problem of contras, we have to be really careful. I mean, you don't instantly remember what the correct balance is. Sometimes, most of the time, you don't use debits and credits in real life. Most of the time you have to kind of think through it and start with something you really are sure of. So in this particular chapter, we're going to deal with a big new contra account, and I've got it shown right here. The contra is going to be called allowance for doubtful accounts. It could be called allowance for bad debt. It could be allowance for uncollectible accounts. They use a lot of different phrases, but they use that word allowance consistently. It is a contra. It lives in asset territory. Assets are normal debits, so if you live with normal debit balances and you're contrary, you're backwards, it means a normal balance in the allowance account is a credit balance. It's going to be on the right-hand side. So a normal balance in the allowance is a credit entry. What does that do? It causes us to show a net realizable value, shown here, a line here, that's the combination of the debits up here in accounts receivable minus the credits down here in the allowance account will give us a net realizable value. We expect it to be on the debit side. We would be looking at the accounts to find out why it's negative if it turned out to be on the credit side. The anticipation is the net realizable value is positive. The current financial crisis, some institutions would argue that didn't happen to us, but that is what we expect in normal presentation of a trial balance, that the net realizable value, which is not a separate account, by the way. There isn't a T account, a formal T account for net realizable value. It's a computation of the two accounts that are used to calculate it, and those two accounts would be the control account for accounts receivable, which is made up of all the subsidiary accounts receivable, all the customers that owe you money build up to make accounts receivable control, and then collectively all of the reductions in those receivables. And we'll learn out why we have to have a reduction in receivables, why we use this account called the allowance account, what it means, what the theory is, what we do with it as we go through the next few days of the lecture. Okay, but this is intended to be just a quick review for you of how you have to deal with debits and credits, and you have to deal with them in this class. Most of the output in Accounting 202, the question will ask you something and it would say, please prepare the journal entry for this. Please prepare the journal entry. The journal entry is where you know your debits must equal in total your credits. You can't have anything out of balance in a journal entry. You must select the correct accounts. You must make them go in the direction you want them to, up or down in the process. And so we can't get away from debit and credit mechanics. When you first are shown debit and credits in Accounting 201, you rightfully would say, why do they make it so complicated? Why can't we just go plus and minus? Answer is because if you do that, you will make vastly more mistakes and you will have vastly more difficulty in dealing with complex accounting transactions. To know that, if you use debit and credit model to make accounts go up and down, to know that, you must have a quality of debits and credits whenever you change any of the accounts in the system is a massively valuable tool, and it just keeps you on track in a way that not having debits and credits won't. So invented again back in the 15th century, this debit and credit idea has survived time, and it still becomes this incredibly valuable tool. And it will become real apparent to you in this course. We're going to see journal entries that might have 8 or 9 accounts in them. And at some point, you're going to plug in a debit or a credit to balance that entry, and that debit or credit is going to be a gain or a loss, for example. If you didn't have that notion of equality of debits and credits, you would struggle to understand whether you had a gain or a loss and how it affected your accounts. So if you can put up with debits and credits till you get comfortable in how to make them work, life is easy. If you don't, life is very difficult in studying accounting. And I want to remind students too, don't expect that you know the correct balance or the normal balance right off the top of your head. You don't speak of these things outside of accounting. You don't use them outside. You need to think about it for a little bit. I remember when I first studied the first accounting course, I'd sit in class and the instructor would ask a question, is it a debit or credit? And someone next to me would say immediately what it was, and I would just, how do you know that? How can you have memorized? How can you be so sure? It just comes with experience. But because you can't do that is not a problem. Just learn how to think through the transaction and know which direction you want the accounts to go first, and then go ask, now how do I make that happen with this debit and credit thing? Go back to the account classification. You know what makes them go positive by this little color map. You can make them go down. You can apply a negative amount to them by jumping to the opposite side. You can keep on track. And you always know when you look at the final journal entry you're dealing with, if you don't have equality of debits and credits, then something's wrong. Or if your journal entry has something odd like you're crediting an expense account and you're not making a correction or anything, but it wind up having to have a credit to balance, and it's an expense account that you know is involved, you'd back up and say, whoa, I think I've got this backwards. I think if I back up and thought about it a little bit, I'll get it correct. So debits and credits are self-correcting, and they help us all the way through. Okay, so that's a quick kind of Accounting 201 reminder. Let's go look at our series of PowerPoints we have here that should help us deal with it. This is, I use a series of PowerPoints that I have recorded an audio to. They're on Blackboard under Lectures. This is going to be a second recording, we hope, if this technology works and we can make it happen. We're going to have it available on Blackboard for you. We'll see how it goes. But rest assured, what I'm showing you here, everything is sitting in flash files on Blackboard. You can hear my audio in a canned scenario. It's not a freewheeling lecture. It's planned and scripted, but it's there, and it's a great review. You get through them using page up, page down, or mouse clicks. I also can get you links to just the PowerPoints for these if you want them. Send me an email. I'll show you the link to these things where there's not an audio associated with it. Some students like those. They want to print them out and use those to study with. That's fine. Just send me an email. Okay, here we are. We're studying Chapter 9. And the reason you saw a Chapter 10 there is because these come from a different textbook that I'm involved in that's just numbered differently. So there's no issues there. All right, here we go. Receivables are assets. We saw that in the previous slide on the color map. We would make a receivable bigger with a debit. How do you get a receivable? You sell something. When you say accounts receivable, it means things that are owed to you through the normal course of business. You might sell merchandise and wind up with an account receivable if you sell it on time. Or you might perform a service and wind up with a receivable. So we would be debiting accounts receivable because we have this asset, which is a right to receive payment. We would be crediting sales. And that's how you wind up with a receivable. If the sale was for cash, you would not be debiting accounts receivable. You would be debiting cash. My asset is cash, not a receivable. So a clear distinction there. And you don't run cash sales through accounts receivable and then take them right back out, which sometimes students might be led to think, well, why don't I put it in a receivable? It's a cash customer. I'll put it in a receivable and then instantly take it out because they also gave me cash and put it into cash. No, we don't do that. We only record receivables for sales on account. The phrase on account means you're going to take the goods from me, but you're not going to pay me till later per our agreement. We're also going to study notes receivable. Notes receivable are a little different. They fall under a different document. UCC law governs accounts receivable. If you have a dispute on those, you go to court and you argue under this huge basket of Uniform Commercial Code about what your rights are and what you can do. Notes receivable are a different instrument. It's a piece of paper, a document that is signed by your customer, the borrower, and it has contractual rights spelled out in the document itself. So you would sue if someone didn't pay you under a note. You sue for specific performance. Judge, this party owed me money and promised to pay, and they didn't pay. I'm here to court to get satisfaction, to try to make them pay, to try and use the body of law to help me get my money back from them. That's different than accounts receivable, and it's thought that notes receivable have a little bit more of a hook. They're a little bit more onerous on the borrower or the party that owes the money, because you have more law and more things you can do in the law to impose upon you. They also typically involve interest. And so why do you want it in a note receivable? Because it's going to be a while before you pay me, and I want to be paid for you're using my money over time. Notes receivable involve interest. We keep them separate. We keep them in separate accounts. We're going to study both of those as we go through here. Okay, let's dispense with a couple of terms here that are going to be on the test, and they're going to pop up, and they're common in the industry. They're not at the top of the list as difficult ideas or critical ideas, but they're worth probably 10 points on the test to be able to distinguish what the word means and how it's applied. The first word we see here has to do with accounts receivable, and it's called factoring or factored. In the world of finance, commercial factors are active financial institutions, non-banks typically, who offer firms cash in exchange for the purchase of their receivables. So the firm says, I desperately need cash, and that is one of the #1 challenges of managing a business. It's such a scary headache to have to meet payroll and meet all your other obligations and keep your doors open, and to have your assets sitting in a receivable. And why were they put in a receivable? Well, I had to sell on account because the industry does it. If I demanded cash, I wouldn't do business with these customers. I had to sell on time, but you know what? I need the money this Friday, and it's not coming in for weeks. Factor, can you help me out? And the factor would say, yeah, here, we'll give you cash. You give us the legal right to collect your receivables. Now, that legal right in some cases could involve the factor sending a notice to your customers and says, hey, under the law, under our agreement, you now have to mail your payment to me, Joe, commercial factor. Don't mail it to the business because it's owed to me now. I purchased it from him. You send me your payment. That could happen. Businesses don't like that. It doesn't look good to your customer to have a letter from your factor saying don't send it back to the business that you bought the material from. So it's less common, but in very scary, risky situations, the factors will sometimes demand that. Or the factor could have a lockbox agreement where it just comes to ABC Supply, P.O. Box, blah, blah, but ABC Supply doesn't have access to the P.O. box. Only the factor does. So the customer doesn't know. The factor has control over the receipts. That's a helpful way to deal with the problem of notifying the customer that you're scrambling to get cash all the time. Factoring is done for firms of less strength that don't have the credit they need to get more convenient credit facilities from banks. It's a critically important type of financing. It's very expensive. Factors charge a percentage of your receivables. And so you might be using the money, it's going to be here in 3 weeks anyway, but I got to have it Friday to meet payroll or my employees are going to kill me. So you might be using the money for 3 weeks, The factor is going to charge you some percent, and when you blow that up into an annual interest rate, it's very expensive. So what does a factor want? 2, 3, 4, 5, 6, 10%, depending on who you are, what kind of receivables you have, etc. So it's not the desired type of financing, but sometimes firms can't get bank financing. And now in our current recession, given the troubles we have, this is probably much more common now, factoring. On the other hand, you could enjoy strong credit. Let's take a minute and let's go back to this idea of credit strength. When we talk about credit strength, what we're talking about initially is solvency, which means the size of your equity relative to your total assets. You have tiny amounts of equity. You may be reaching a point where things go badly. You owe more money than you have in assets. Excuse me. That would not be helpful. So what I'm talking about for credit worthiness of a firm is the level of capital they have. So if you have tiny amounts of equity, this box here is very small relative to this total assets. You're reaching, depending on the industry, and you might be reaching a point where people are afraid of you that you won't survive normal business cycles. That's one measure. Remember also in Accounting 201, we drew a line across assets, we drew a line across liabilities, and we classified both assets and liabilities as being current or not, meaning under liabilities, is it due this year, then it's current. Is it due after this year, then it's long term. On assets, is it going to be converted to cash or used up this year? If it is, it's a current asset. So we could measure their liquidity by how well they're able to pay their bills, comparing current assets, the available cash you have this year coming in, compared to the obligations you have listed, your current liabilities. Those measures are what banks and factors use to decide how creditworthy you are. So, back to this idea of what is a pledge then. The pledge that we're talking about here is simply a bank deciding that you're reasonably strong. You have good liquidity by a current ratio measure or quick ratio measure. You're reasonably solvent. Comparing you to the industry, you look okay. We think you're going to be around. We think you can pay us. We're going to let you pledge your accounts receivable to us in a document, UCC document, a filing. You tell the world, public notice, there's a record of it. All my receivables really technically belong to Chase Bank. I just pledged them to them. In return for that, the bank might say, all right, we're going to give you a line of credit. You can draw it up and down. It's a revolver. When you need some cash, you send us your receivable report. We look at your receivables. We don't want to advance more than you have in value, so it's not unlimited. We kind of control it by the size of the receivables you have. But we're going to let you have that line of credit, so when you need cash and your cash is sitting in your receivables, you can borrow against them quickly online. Just move some cash from your credit line. Let's look at a big picture again here. Move your cash from your credit line over here, line of credit payable in the liability area. You just get online and move it right over into your checking account into cash, and then pay your bills and happily move on. Every year we'll review it. We'll charge you a fee to review it. We'll earn interest when you have it advanced. When you get extra cash comes in the end of the month, you're awash in cash, reach over and pay down that line and reduce your interest expense. Firms like that. Businesses like that. That's a great deal. It's part of the normal healthy operation of any firm to use an operating line of credit in that way. So, given that, we're back here understanding this idea of pledged as compared to factored. In pledged, you don't sell your receivables. You give the legal right to them to the bank. If you tip over and go out of business, the bank can go to a judge and say, Judge, these receivables, they're ours. We own them through this UCC-1 financing statement. So that's an important idea about how firms deal with accounts receivable and get cash early on before the receivable comes in for collection. Okay, let's move on. The big issue that we're worried about this week is this issue right here. In the process of granting credit, firms are inevitably faced with the problem that some customer they run into is not going to pay them, is not going to come through. They try to have high levels of credit standards. They don't grant credit casually. They look at the financial accounts for the statements for the firms that do business with them, and they review them annually. They set limits on how much they'll sell to you on account, but in spite of all their best efforts, run along in 3 years ago and 4 years ago in the Puget Sound business cycle, and then enter into our terrible recession we're in now. What's it caused? It's caused a lot of firms to have trouble paying their bills, serious trouble paying their bills, can't pay their bills. Those accounts become uncollectible. We're using a lot of words to describe those problem accounts: uncollectible, doubtful, and when we get over to the income statement, we're going to typically call them bad debt, and we're going to see how that works. But this is why we're studying this chapter. It's because of this problem right here. It is the substantial, difficult part of this chapter, the issue of uncollectible accounts. Okay, you can't get away from it in business. You can say to yourself, oh, heck, I can pick out a bad deal and I'm going to turn it down when I see it. But you can't see into the future. You don't know what's going to happen. And you've got to accept the fact you'll never, over a long period of time, collect 100% of your receivables. So, when you can't collect a receivable and it's obvious you're not going to get the money, like you get a notice of bankruptcy and you look into it and you realize there's nothing here. I'm not going to get that $10,000 they owe me. In accounting, there's two ways to deal with that. This is important now, big picture, two ways. One is called the direct write-off method. The second one, the one we're going to spend so much time on, is called the allowance method. Now, FASB GAAP, the rules that we study, the rules that publicly traded firms must follow, the rules that are the oversight of the Sarbanes-Oxley Committee, they say to us, you cannot use the direct write-off method. We don't allow that method. You must use the allowance method. Now, we'll talk in a minute about why that's true. But this is a big deal. The little mom and pop businesses, small firms that aren't publicly traded, that don't have to produce an audited financial statement under GAAP, that under no obligation to, maybe their bank doesn't require it or they don't use a bank, they typically would use the direct write-off method. And we'll make a distinction as to what those differences are and why they exist and what the problems are. And it's a bit involved because it involves the IRS too. We'll talk about that in a second here. All right. Always in accounting and rules, there's this issue of materiality. And sometimes there's involved rules that you say, you know what, I know that's a really involved rule, but I'm going to ignore it. Why? Well, because the things that it affects on my account are so tiny. They're so tiny, it's never going to change the opinion of someone reading these statements, whether I use the rule or didn't use the rule. It won't affect their opinion of me. Like, I sell on account, but you know who I sell to? I sell to the federal government. That's the only party that I sell on time to. And the only reason I would get a receivable from them that I can't collect is if I recorded it wrong in the first place, or there was a misunderstanding about the contract, because the federal government pays and pays and pays. It may take forever, but I get paid. So I don't want to use an allowance method. I don't want to use the complicated write-off method required by FASB. I'm going to just write off any accounts if I ever have one, and I haven't had one for 5 years. Well, what that argument is, it's materiality. Don't follow a complicated rule if there's no reason to. There's no purpose in it because it doesn't change anyone's opinion of your statements. Materiality comes up in all kinds of things. Second idea, broad conceptual idea or principle, conservatism. In accounting, you're supposed to say to yourself, if there are two equally likely outcomes, this could happen A or that could happen B. They're equally likely. I don't know which one's going to happen. You're supposed to pick the one, if you're using it to make a decision about the accounts, you're supposed to pick the one that makes the firm look the worst. That's conservatism. We'll be on the conservative side. We don't know whether we're going to lose 10,000 or 50,000 because the deal's in court right now and it's a lawsuit. We know we're going to lose. We don't know if it's going to be 10 or 50. I got to produce a statement. I'm obliged to pick 50 because I have to be conservative. So that's conservatism in accounting. They both involve accounts receivable decisions. Okay, we'll use those as we proceed. All right, so back to this idea. Inescapable fact, if you sell on account, some people won't pay you. You got to deal with it as we move on. Let's look at the direct write-off method. Remind ourselves now, direct write-off method, FASB doesn't like, GAAP doesn't like. You'll never see Boeing using the direct write-off method. They have to produce audited financial statements under generally accepted accounting principles, and they can't use it. It is not allowed. Little firm here, this could be happening right now. It is happening. Wilson Excavators, they're working for a home builder. They're owed $6,750 by Oakwood Homes, and they just get a notice in their offices. She opens the mail. It's a bankruptcy notice. They've been notified that their customer, Oakwood Homes, is bankrupt. Okay, that receivable, that asset on their balance sheet is no longer an asset. They know it. They are conservative and realistic. They've got to get it off. Accounting obliges them to take it off if it's not an asset anymore. So they're going to use a direct write-off, and here's what they do. They open up their journal, the green space up here. They have a quality of debits and credits. What accounts do they use? They're going to use an expense account. See, it comes from the income statement right down here, an expense account. In this case, this particular chart of accounts said, let's call it uncollectible account expense. Most of the problems we see in the text, they call it bad debt expense. They mean exactly the same thing. You have to get comfortable with the fact that accountants use different phrases for the same account. Not within the same set of accounts, but one firm to the other may pick uncollectible accounts or they may pick bad debt expense. Just depends on the accountant's preference. What's the credit entry to this debit? This debit here is this debit that arrives in the expense area. The credit goes over to the asset area, making the assets smaller because they lost that value. They credit the specific account in the subsidiary ledger for Oakwood Homes. That receivable is gone away, zero. That accounts receivable from them is gone. It's empty. That writes off the account. It's gone and created an expense at the same time. Now watch what the argument is against the direct write-off method. When was that $6,750 earned? Well, actually 2 months earlier, which was in a prior fiscal period. You know, they got the notice in January. They earned this money in the last fiscal period. Well, we've then, by what we just did, we violated the sacred, most important idea in accrual accounting under GAAP. It's the matching concept, which says something very simple. It says that over on that income statement, you've got revenue, you better find absolutely every expense associated with that revenue and match it up. Match it up when you present a financial statement. Don't leave any expenses out if you incurred the expense to enable you to earn the revenue. Otherwise, you're going to give a completely misleading picture. In this particular firm, they reported the year prior they had this $6,750 of revenue in the income statement, no bad debt expense associated with it. Fast forward 3 months, their statement shows $6,750 in expense and no revenue associated with it. It shows a great event for the prior year and an awful event for the subsequent year, when actually that expense should have been recorded back in the prior year. Now, you should say to yourself, well, that's pretty good, but how in the world did they know when they did the work for Oakwood Homes 3 months ago that they were not going to get paid? If they would have known it, they would have never done the work. And that's absolutely true. That's the problem. And so accountants in GAAP and FASB have said we'll figure out a technique to deal with that problem. And that's what we have to worry most about this. Now back to the direct write-off method. This little wrinkle I wanted to tell you is when you talk about the IRS and what they allow and they don't allow, remember firms produce audited GAAP statements, and then they turn those statements over to their tax department, and the tax department redoes them under a different set of rules and comes up with typically different net income, different revenue, different expenses to submit to the IRS, because there are two different sets of rules. One of those, of the many differences, one of them is the IRS only allows you to use the direct write-off method. They will not let you use the allowance method, and we don't even quite know yet what the allowance method is about. But it turns out, when we studied this in the next few slides, the allowance method involves a guess. You have to guess about bad debt. The IRS is pretty cynical about human nature, and they say, we know what you're going to do if you're allowed to guess. You're going to guess really high and lower your tax bill this year. We don't like that. So no allowance method, no guesswork. You've got to proceed with only actual events. When the write-off actually occurs is when we're going to let you create an expense associated with it. Okay, so that's an important idea. GAAP, yes, and no for the allowance under the IRS. Okay, so let's go back, and now what is this allowance method all about that we're talking about? We just have a few minutes. Just going to introduce it, and then we're going to proceed to look at the complexity of rules involved in that. It's going to take us at least another day to get through those. All right, when you follow an allowance method to deal with this bad debt problem you have in your accounts, which you have to under GAAP and FASB, you stand at the end of the year when you're ready to produce a financial statement and you look back and you say, I wonder how much bad debt we have sitting here in our accounts receivable. Based on what we did this year, maybe based on our sales on account volume, maybe based on the balances in accounts receivable, is there any way for me to just guess about how much bad debt there is? I know it's going to be something, so even a bad guess is better than ignoring the problem. And the reason I want to guess is I want to put some expense into my accounts before the event actually happens, before the event happens where we get the notice from a specific business that they won't pay us. So this guess or this estimate, which drives the IRS crazy, is what FASB and GAAP insist upon. And so we are going to do that. We're going to stand at the end of the year and guess about bad debt expense. And when we do that, we're going to make some journal entries. So let's take a look. We use a contra asset account that I already mentioned to you. Contra asset account is backwards from where it lives. It lives in the asset area, but it's not a normal debit balance. It's a normal credit balance. Why do we have to use a separate account? Well, we have 300 customers. They all owe us money. Do you know which one isn't going to pay you? No, you don't at the end of the year. If you did, you would write it off. You know that some won't pay. Question? Yeah, that's right. You in good faith are dealing with customers who are dealing with you generally in good faith, and things happen to people. You know, go ask businesses in the last 3 years if they would have ever envisioned having the challenges they are now. They would have said no. I mean, our business was great. Now it's just on death's door. So we use a contra asset account to deal with this. I like to show this little takeaway. I call this a takeaway bucket. It's just a bucket that we hang on the control account for accounts receivable. It says, oh, by the way, you see that balance of 7 up in accounts receivable? It isn't going to really realize a 7. It's only going to be 6 because I've got this allowance, this takeaway bucket, credit balance of 1 sitting below it. And they're tied together. You can't break them apart. Wherever accounts receivable goes, along with it goes the associated contra account, the allowance for doubtful or uncollectible accounts or bad debt or any phrase you want to use for that. So that's the mechanism. That's the account we use. You do it, really important idea here, you do it only in the adjusting process. Do you add to the allowance account and create bad debt? So look at this journal entry up here. It's described as an adjusting entry. We know those are done at the end of the fiscal period to get the accounts in order to produce a proper set of financial statements Well, one of the issues that we have here is that the debit is going to cause us to have less net income because we're just slapping an expense over there. Did it really happen to us yet? Did we actually suffer the loss in a specific incident of a customer telling us, I'm never going to pay you? No, we haven't yet. We just know that some of them won't pay us, and we're going to go ahead and expense those using the best guess we have. And we'll talk about later how we guess. But the important point is that you're putting the expense over there, causing net income to go down. That's the debit. The credit goes to the allowance account. That makes the net realizable value of the accounts receivable go down. You're losing assets. They're going over as an expense. Even though nothing has happened, you didn't get any bankruptcy notice, no one called you on the phone and told you we're done, nothing. This is just prudent guesswork about what you know inevitably is going to happen at some level in your accounts. Okay, so when would a specific account receivable be removed? What we just saw there was we didn't touch any of the accounts sitting in the control account. They're still sitting there in total. Back up here, they're still sitting in accounts receivable, total of 7 in this example. When we record that allowance and put $1 in there, and we call bad debt debit $1, we change the net realizable value. We didn't affect any single customer in those accounts. They still are shown in the accounts at the balances they have. So question is, when is a specific receivable removed because it can't be collected? Answer, when you get information subsequent to the adjusting entry in the year following or the fiscal period following, when you get information that says we're not going to pay you. Only then do you get a specific account to a specific customer written off. Let's see if this helps us. You got a proprietor here, runs an espresso stand. The dog is her customer. She's been selling lattes to him all year on account. Probably shouldn't have, but she did. He owes her $1,000, and she just gave him a latte. He says, you know what? About that money I owe you've been bugging me about, I'm broke. I'm never going to pay you. But don't you have an allowance for me? This dog thinks he knows something about accounting. Oh, I can't pay you, but you've got an allowance for me, don't you? Well, she does, but she's not any happier about the fact that this dog's going to walk away from the obligation. So here's what happens in the account. We write off what the dog owes us. See that Mr. Dog receivable? Credit that asset account. Make it go down. Go away. He's gone. I was telling the world I had an asset there. The dog's going to pay me. No, the dog's not going to pay me. I don't have an asset anymore, so I'm taking it out. But look at where my debit goes. That's the hard thing to remember here. We don't run over and create an item in the expense, bad debt expense. We debit the allowance account itself. We debit that contra asset account. So a debit makes it go down because it's sitting there with that credit balance in it. This makes it go down. See, this allowance in this particular case had a balance of $2,500. We debited it. Now the balance is only $1,500. So we had to use up some of our valuable allowance to deal with this specific write-off. Students often want to debit an expense account again. Only in the direct write-off do you do that at write-off time. In the allowance method, the harder of the two, the difficult method we're studying here, you never create bad debt expense or uncollectible account expense except when you're adjusting for it. Subsequent to that, you hammer the debit to the allowance account. Okay? We'll leave it at that, and we're going to pick this discussion up tomorrow. We'll get into the last complexity of rules that we have to deal with.